but says that if growth stocks can turn in good earnings, they could still catch a bid here. Joining me now is Barry James, president of James Investment Research. Barry, welcome. Just your thoughts, first of all, on the risks around this Fed tightening?
Well, I see two things. There's in Chinese mythology, there's a dragon called Hung, the rainbow dragon. It's got two heads, though. That's the problem. One is COVID for us. The other is the Federal Reserve. The COVID head is going back to sleep. Even though our company had to cancel a 50-year anniversary trip because of COVID, it is going to go back to sleep. It's the other one. It's the Federal Reserve. And we just look at that, the great, reporting that you just had. At the beginning of the year, it went from an expectation of 3 hikes to 4 hikes. And what has the stock market done since? It's gone down. Next week, we get the information from the Federal Reserve of what they're really thinking. And Fed Chairman Powell is very good at communication, so I don't think there's going to be much of a surprise. But if it's not above 4 times this coming year, I think the market will start to settle down.
All right. So what would you do then in that investing environment? I know you're not typically the kind of person who looks to growth stocks, or people right now are all tilting towards value and thinking that's the surefire trade for the year.
Yeah, that's a great question, Kelly. In our James Balanced Golden Rainbow Fund, we have stocks and bonds. On the bond side, if I had cash, 2 years, wouldn't go beyond 2 years. That's the steepest part of the curve. You do something called riding the curve down. So over 2 years, you at least get your 1% interest back, regardless of what happens with the Fed this year. On the other side, on the stock side, we really do see that the reopening is going to be very important, and higher interest rates is going to be very important. The higher interest rates hurts growth stocks because they're based on the value of those future earnings, and they're not worth as much today if interest rates go up. So more of the value, more of the cyclical types of names, and that's what we would be favoring from energy stocks to finance stocks to industrial types of stocks at this juncture. Not that the others, you have to get out of them entirely, but that's probably where the next wave really is going to be.
Yeah, you guys like Pioneer, Regions Financial, and Eaton Corp. A final question, though. You do think this earnings season could be a period, and I wonder if the banks were already starting to tell us that. Their earnings missed in some cases, depending on the metric that you look at. The stocks have been down substantially. And what do you expect as earnings season continues to play out could be a bit of a rotation here?
Well, in the banking sector, you're right. We're seeing some misses, and that's mainly because of personnel costs. In order to attract and keep the people that they want, the larger banks and regional banks are having to spend more. But if we look this year, so far this year, all those sectors down, one of the few sectors that's up this year is the finance sector, and that's because of the steepening of the yield curve. It does make things, more profitable for a lot of these institutions. So I don't think I would be afraid of them at this point, and it might actually be some good entry points as these prices have come down pretty much so far this year.
All right, Barry, thank you. It's good to see you. We appreciate it.